Solutions to Assignment 2, Part 2 on financial ratios. Okay, let's move on now to problem 11. Okay, we have Firm A and Firm B, which are nearly identical firms except for their capital structures. Firm A is financed entirely with equity. It has no debt. Firm B finances 50% of its assets with debt, which has an 8% interest rate, and therefore obviously 50% with equity. Both firms have $1 million of assets, a basic earning power BEP ratio of 20%, and a 40% tax rate. Compute the return on equity ROE for both firms. Okay, I've got Firm A over here in the left panel. Its debt to asset ratio is 0 because it's financed entirely with equity, no debt. Firm B has a debt to asset ratio of 50% on the right hand side panel here. Okay, the interest expense for Firm A obviously is 0. It has no debt. The interest expense is the dollars amount of debt times the interest rate, but there's no debt. Firm B has $500,000 debt. Remember, there's $1 million of assets, 50% debt ratio, so there's $500,000 of debt. The interest rate on the debt is given as 8%, so multiply by 0.08, and the interest expense that Firm B must pay annually is $40,000. Now the BEP ratio for both firms, I draw it kind of in the middle here, is EBIT over total assets. Both firms have a BEP ratio of 20%, so I substitute in 0.20. Both firms have $1 million in total assets. I put that in the denominator. Therefore, we know both firms have EBIT of $200,000. That's what we use the BEP ratio here for. Okay, now let's look at the income statement, and then we'll look at ROE for both Firm A and Firm B. Okay, let's look at Firm A first. It has EBIT of $200,000, as will Firm B when we get to it. Has 0 interest expense. Therefore, EBT is $200,000. We were given that both firms have a 40% tax rate, so it would pay $80,000 in taxes and therefore have net income of $120,000. We'll look at the ROE in a second. The Firm B, also with $200,000 of EBIT, has $40,000 interest expense. We just computed that on the previous slide, leaving us EBT of $160,000. If we take 40% of that, it would pay taxes of $64,000 and then have net income of $96,000. Now, note that the ROE for Firm B is going to be higher than the ROE for Firm A, and we calculate both ratios below. It's net income over equity. Take the $120,000 for Firm A, but divide by 1 million because the assets are financed entirely with equity, therefore there's $1 million of equity. So ROE is 12% for Firm A. While Firm B has only $96,000 of net income, it only has $500,000 of equity. Therefore, its ROE, when we do that division, is 19.2%. So note that the firm that has debt financing with a BEP ratio of 20%, they both have BEP ratios of 20%, its ROE will be higher. And the general rule here is that as long as the BEP ratio, keep in mind the BEP ratio was 20%, so we used down here, it was given as 20%. As long as the BEP ratio exceeds the interest rate on debt, and it does, it's 8%, then as you use more and more debt financing, you will increase the ROE. And that's what's happened here. That's why the ROE is higher, is because they're taking that higher level of profitability with a 20% BEP, basic earning power ratio, but they're financing the assets 50% with debt, which only has a cost of 8%. That is levering upwards the ROE for the firm. So we get 19.2% versus 12%. Problem number 12. AEI Incorporated has $200 million in assets and its tax rate is 40%. Its basic earning power BEP ratio is 12% and its return on assets ROA is 6%. What is AEI's times interest earned ratio? Okay, well the times interest earned ratio is EBIT over interest expense. And if we look through here, we don't have either one of those, do we? So we've got some work to do. Okay, we were given the BEP ratio, so let's write it out. BEP, basic earning power, is EBIT over total assets. We were given the BEP ratio is 12%.12. We were given total assets of $200 million. Therefore, we know that EBIT is $24 million. We were also given that ROA is 6%. Well, ROA is net income over total assets. Put into 0.06 for the ROA, and we were given $200 million of total assets. Therefore, net income must be $12 million. Okay, we're not there yet, but we're a step closer. We've got the numerator. We need interest expense. We have net income. What do we need to do? We need to work backwards up the income statement. If net income is $12 million and the firm has a 40% tax rate, divide the $12 million by 1 minus 0.04. EBT would be $20 million. If EBT is $20 million and interest expense, and EBIT is $24 million, then interest expense must be $4 million. Right? So we took the net income of $12 million, we divided by 1 minus t to find EBT of $20 million. Knowing that EBIT was $24 million, remember we solved that over here, we then were able to determine that interest expense is $4 million, and therefore the times interest earned ratio is $24 million of EBIT over $4 million of interest expense, or 6.00 times. Number 13. Petrie Company has $1,312,500 in current assets and $525,000 in current liabilities. Its initial inventory level is $375,000, and it will raise funds as additional notes payable and use them to increase inventory. How much can its short-term debt, notes payable, increase without pushing the current ratio below 2.0? Okay, we know the current ratio is current assets over current liabilities. The present current ratio, I don't want to say current ratio, so I'll call it the present current ratio. Take the current assets of $1,312,500, divide by the current liabilities of $525,000. The current ratio is presently at 2.5. Okay, let's define X as the increase in inventory. And since the inventory is going to be financed with notes payable, it's also equal to the increase in notes payable. They have to be equal increases, because we were told its initial inventory level is $375,000. It will raise funds as additional notes payable and use them to increase inventory. So whatever notes payable increases, inventory increases. We're going to call that variable X. Okay, now, both inventory and notes payable are in current assets and current liabilities, respectively. Current assets includes inventory. Current liabilities includes notes payable. So all we need to do is add X to both the numerator and the denominator, since those amounts are equal, and set that equal to 2. Solve for the level of X. X here represents the inventory that's being added in the numerator, current assets. In the denominator we have current liabilities. That represents the notes payable, which is exactly the same amount as inventory. What amounts could you add to both the numerator and the denominator and keep the ratio at 2.0 and no lower? We'll solve that for X, which is just some basic algebra, which I show the steps here. And we find out that X is 262,500. Might be a good idea for you to pause the slides and just work through. Just multiply through the parentheses, collect terms, and solve for X. Number 14. Haskell Electronics Incorporated currently has $350,000 in receivables, and its days sales outstanding, DSO, is 35 days. It is considering a more lenient credit policy in an effort to increase sales. Management believes the new policy would increase sales by 15%, with an increase in the days sales outstanding to 45 days. What new level of sales and accounts receivable would result from this change? We'll, of course, assume 365 days per year, which is pretty standard when you have to use the number of days in a year in a ratio. Okay, the days sales outstanding ratio is accounts receivable divided by sales per day. And we'll start with the initial DSO ratio of 35 days. That ratio is when accounts receivable is $350,000. Divide that by sales per day, and we can solve for the sales level. So the previous sales level was $3.65 million. Okay, so it's not going to consider a more lenient credit policy to increase sales. and they believe the new policy would increase sales by 15%. So let's increase sales by 15%. We'll put the new sales level in. We'll change the DSO to 45 days and see what the accounts receivable level would be. Okay, the new sales level, which we were asked to determine, is $4,197,500. Again, we're going to put that in for the sales amount, change the DSO to 45 days. They expect a more lenient policy to increase days sales outstanding, and then solve for accounts receivable. And if you go through the little bit of algebra there, you'll find that accounts receivable would be $517,500, which of course would be an increase, right? As you would expect, from $350,000 to $517,500. 15. Fontaine Incorporated recently reported net income of $8 million. It has 1 million shares of common stock, which currently trade at $100 a share. Fontaine continues to expand and anticipates that 1 year from now, its net income will be $11.4 million. Over the next year, it also anticipates issuing an additional 200,000 shares of stock so that 1 year from now, it will have 1.2 million shares of common stock. Assume Fontaine's PE, price-earnings ratio, remains at its current level. What will its stock price be 1 year from now if that were the case? Okay. The current earnings per share is 8 million net income divided by the 1 million number of shares. They currently have $8 per share of earnings per share. So the PE ratio is currently $100 per share, right? That's what it's at currently, $100 a share, divided by the earnings per share we just calculated. The PE ratio is presently at 12.5, and we're going to hold it there because we're going to assume at the next stage here, after the investment and the issuance of shares, that it's going to stay at that. Okay, the new earnings per share will be the anticipated net income level of 11.4 million, but of course they had to issue 200,000 shares, so instead of a million, we'll use 1,200,000 shares. So the new earnings per share will be $9.50. The PE ratio is price per share over earnings per share. So we can calculate the price per share by taking earnings per share times the PE ratio, and we're going to hold that PE ratio constant at 12.5. So we're kind of using the PE ratio as a multiplier, if you will. We're going to take the new level of earnings, which is $9.50, and multiply by the previous PE ratio to estimate that the new price would be $118.75. That's kind of a back-of-the-envelope type calculation to determine the effect on stock price. It's not one of the more sophisticated methods. In finance, we devote a lot of time to more sophisticated methods for estimating how these types of events would affect the stock price. But we often like to do what I call back-of-the-envelope, quick and dirty calculations, estimates, if you will. Okay, our last problem, we have the Berry Computer Company, and its industry averages follow the next slide. Here is the balance sheet for the Berry Computer Company. Here is the income statement for the Berry Computer Company. And here is the industry average ratios for current, quick, DSO, and so forth. And we are asked to calculate the indicated ratios for Berry. Now, rather than just monotonously just read you all these calculations, I'm going to put them up, pause for a moment, and suggest that perhaps you pause the slide and perform those calculations, make sure that you can do that. And then continue to get the remaining ratios. Oops, went too far. Let me go back. Again, hit pause if you need to. We were then asked to construct the DuPont equation for both the Berry Company and the industry. For the Berry Computer Company, remember a DuPont analysis computes ROE by taking profit margin times total asset turnover times equity multiplier. And the profit margin we had is 1.7% or 0.017. Total asset turnover 1.7. I just took assets and equity off the balance sheet. And we had an ROE of 7.6%. Doing the same thing for using the industry data. We get ROE is 0.012 times 3 times 2.5 equal 9%. I got that 2.5 by this simple idea that the, let's just go through this. We know that D plus E is A, right? A is equal to D plus E. If I divide every item by A, I have A over A, which is 1, is equal to D over A plus E over A. Next, moving down to here, I subtracted D over A from both sides and put the E over A on this side. So I have E over A is 1 minus D over A. So I took E over A is equal to 1 minus 0.6 because the debt to asset ratio was 0.6. That gives me 0.4 for E over A. Well, the equity multiplier is A over E, so it's simply 1 over 0.4 is 2.5. I suspect there's other ways to do it. To me, sometimes the best way to do it is the first way you see. Maybe there's a step, maybe there's a method that's one step quicker. I don't know, but this worked for me. Okay. Lastly, outline Barry's strengths and weaknesses as revealed by your analysis. Well, I summarize as follows. The firm's days sales outstanding ratio is more than twice as long as the industry average. Let's look at that. Days sales outstanding was 76.3 days for Barry. The industry average was 35 days, so yeah, that's much, much higher for Barry Corporation. Indicating that the firm should tighten credit or enforce a more stringent collection policy unless it feels like its policy is better because it's leading to higher level of sales and higher stock price. And we would wonder about that, but I would really want to strengthen this recommendation, say it really goes down to whether they think it's increasing value or not. The total assets turnover ratio is well below the industry average, so sales should be increased, assets decreased, or both. It's easier said than done. But we would at least start looking along those lines. While the company's profit margin is higher than the industry average, its other profitability ratios are low compared to the industry. Net income should be higher given the amount of equity and assets. And then finally, the company seems to be in an average liquidity position, and financial leverage is pretty similar to the firms in the industry. Okay? Well, this ends our part 2 on solutions to assignment 2.